Hello, I'm Peter Herbert from Insight Training. Welcome to today's short webinar, one of the series we're currently running, looking at topical financial reporting and auditing issues. Today's session is going to look at accounting for aid. This topic we did cover in a webinar early in lockdown. Today we're going to revisit that topic and particularly focus on some of the more frequently asked questions that we've had since. Here's the running order. We'll start off by thinking about government aid, then think about rent waivers, loan repayment holidays, and finish with some key audit considerations. Let's start with government aid. Now, government aid is not limited exclusively to grants, but of course, a lot of the aid does take that format. Let's remind ourselves of the IFRS 102 rules in section 24. We've got an accounting policy choice, the performance method or the accrual method. Remember that when per paragraph 24.5e of IFRS 102, you're getting a grant to provide immediate financial support with no specific future costs to relate that grant to, whatever your accounting policy choice, you recognise that grant as income in the P&L when it becomes receivable. ICW's Technical Advisory Service has done a very good paper on the accounting treatment for a number of the different government support schemes. We'll look at one or two of those in the next few minutes, but do have a look at the guidance paper if you can. There's a link to it on this slide and in a very helpful complementary paper looking at the implications also here under IFRS 105. Okay, let's start off with the CJRS grants. This is the example I want to work through, very similar to the example here within the ICW Helpsheet. So we've got a situation whereby a staff member has been furloughed since the 1st of March. The CJRS claim for the period is 5,000. At the end of the accounting period, 31st of March 20, the grant claim has not been made because the portal wasn't opened. But what the ICW example suggests here is, given that the company had complied with the relevant criteria and is reasonably assured of the money coming in, that 5,000 should be accrued in the P&L for the company for the 31st of March 2020 year end. Remember the way it works from a CJRS grant point of view, whatever your accounting policy of choice, whether you go down the accruals method or the performance method, you effectively will account for CJRS grant in the same way, whatever. I think the sense I get with CJRS, based on the questions we get on courses, is that the money does wash in fairly quickly. There's therefore going to be limited balance sheet impact, apart from possibly where you've got a 31st of March year end. I guess the only slightly emotive topic in relation to CJRS grant has been that you would need to gross it up and show that grant as other income in the P&L rather than netting off against the related wages costs, which some people, I think, are inclined to do. Let's look at some more examples. Here's one. Client with a 31st of March year end applied for a grant from the Retail, Hospitality and Leisure Grants Fund. The grant was received on 28th of March. In which year should it be recognised? This is one of the grants I mentioned a few minutes ago in the context of paragraph 24.5e of IFRS 102. So basically a grant to provide immediate financial support with no specific future costs to relate that grant to. And in that situation, what you would do is bring the grant into the P&L when it becomes receivable. Therefore, if they've physically received the cash on 28th of March 20, they'd bring that into the accounts for the 31st of March 2020 year end. Yes, and I think this is an area where people, I think, are somewhat perturbed by the accounting outcome that you get, if only because, of course, the way that these grants work is they are indeed taxed, and therefore bringing that into the 31st of March 2020 year end accounts will be very unpopular from a tax point of view, because that will be taxed earlier than you'd like, where clearly, although the money has been received early, 28th of March, and although therefore from an accounting point of view, it makes sense to bring that into the P&L in that 31st of March 2020 year-end accounting period, the clear benefit of the grant will be going forward in the next accounting period, which is really, I suppose, when the company concerned is going to feel the pinch really in the relation to the current climate that we're in. But that's the way the accounting rules work. And in fact, what the Institute paper makes clear is that where you've got automatic entitlement to grants of this particular nature, even where you've not applied during the period, but you will actually get the grant for sure based on the fact that the scheme was announced pre-31st of March 2020 year end. You would still bring that into your books for 31st of March 2020. So I think that's quite an emotive topic. I think from a tax point of view, there's real appetite to want to bring the grant income into the P&L in the later accounting period. We've got a 31st of March year end, but what paragraph 24.5e of IFRS 102 is saying is bring it in earlier, because that essentially is when it becomes receivable. The question on government grants, not quite as emotive. We've had one or two delegates asking us this one. When should clients recognise the extra 1K job retention bonus to reward and incentivise employers who keep their furloughed employees? I think the sense I've got with this one is you have to keep those employees until 31st of Jan 2021 in order to be eligible for this extra 1,000 job retention bonus. My thought would therefore be you would not bring that grant income into the P&L until that particular point in time had arrived. And I think a number of people we've spoken to have been very keen to bring that into the 31st of 31st of December 2020 year-end accounts, but fundamentally you can't to the extent that you're not going to qualify until you kept those people in your organisation until 31st of Jan 21, and therefore if you do have a 31 December year-end, it will be the later accounting period rather than the earlier accounting period that you'll bring that 1,000 job retention bonus in to your P&L. Okay, so that's just a few thoughts in relation to grants and some of the more frequently asked questions we'd be getting asked around that. Let's move on and think about rent waivers, so different sort of aid really, aid from landlords now, of course, rather than aid from the government. And again, I think early on in the current situation that we're in, there was certainly some question marks around if you were going to get some sort of waiver of rent from the landlord, would you actually account for the benefit in the P&L as the tenants in the period in which the actual waiver was provided? So keep it simple, follow the cash from an accounting point of view. Would you perhaps in some way, shape or form consider that as being maybe some sort of lease incentive and therefore spread it forward? And as some of you may be aware, we've had formal clarification in the last few weeks from the FRC to decree exactly how in that situation the accounting should work. Should we keep it simple and follow the cash, or should we be a bit more sophisticated about it and spread it forward? And the FRC paper has made really clear how that works. Let's quickly run through the way that particular clarification paper works. It's been published very recently by the Financial Reporting Council. And here it is. And what they fundamentally say is that you should recognise the change over the period changes in lease payments is intended to compensate. So in other words, keep it simple and follow the cash. Okay, bring the benefit into the P&L as the tenants. And effectively the same thing from the landlord's point of view. So follow the cash from the landlord's accounting point of view as well. In the periods in which the rent is waived, subject to 3 criteria. The overall consideration must fall. This particular dispensation will only affect payments originally due on or before June 30th, 21. This is therefore, I suppose, very much a short-term fix to look at a very particular situation arising in the COVID environment, and that's why it's limited to the payments during that particular time frame, and no significant changes to other terms and conditions along the way. Okay, let's have a look at a couple of practical examples and see how this would play out in practice. And here they are. So company A pays 10K per month rent in advance. Lease term ends September 20. Landlord gives 100% discount for April and May 20. Same for company B, but in return, the contract's extended to September 2021. Okay, so looking at those individually, I think in company A situation, I would say there it's quite simple, quite straightforward. There's no particular issue in terms of complying with those criteria on the earlier slide. Apply the IFRS 102 dispensation and spread the benefit over the 2-month period when the rent is not being paid. In simple there, follow the cash. Company B though, the sticking point there is that we've actually got the extension of the lease in recompense for the landlord waiving the 2 months rent. And the key thing to ask there, I guess, is therefore, is that extension a significant modification of the lease? Does that mean that we don't comply with criterion 3? And if that's the case, you would spread forward. You therefore take the 10,000 per month being paid over 16 months. Remember, the first 2 months they're not going to pay. Divide that by the 18-month term, and that will therefore mean we have a P&L charge of 8,900 per month, an accrual of 17,800 builds up to the end of May, and then that gradually unwinds over the remaining period to the end of September 2021. That's what way you would go, I think, if you were to construe there. That was a significant modification, and that third criterion were not complied. And I think the sense I'm getting from talking to people on courses is that whilst landlords are willing to waive rent in certain situations, they do often want something back in return. And I think therefore that third criterion is a key thing to be looking at for both from an accounting and from an audit perspective. Just a final point as well, for those of you that gravitate more towards IFRS rules, not going to get massively down that route today, but you may be aware, for those particularly that do apply IFRS, I'm sure will be aware that with effect from accounting periods beginning on or after 1 Jan 19, operating leases come on balance sheet in an IFRS world. And therefore, I guess this whole aspect of rent waivers becomes particularly tricky in that particular situation, where in the event that a landlord is going to waive rent, do you have to completely re-engineer the lease creditor off the back of that waiver, or do you keep it really simple and in the months when you're not paying rent, quite simply debit your lease creditor and credit the P&L? Again, what the ISB have done is come up with a similar sort of a guidance paper around how that would work in an IFRS world. And yeah, fundamentally, when you meet similar sort of criteria that we saw from an IFRS 1 and 2 point of view, you can keep it simple. You can debit the lease creditor and credit the P&L. But again, when it's more convoluted, when there are certainly additional modifications in the background, you then need to re-engineer your creditor. And yes, that's going to be a much more clunky process in an IFRS world, where the accounting is more complicated based on the way that IFRS 16 works. But there's certainly a corollary there between what the FRC are doing in terms of IFRS 1 and 2 and what the ISB have done there in relation to IFRS 16, given the concessions we're seeing in the current climate. Okay, loan repayment holidays next. I mean, one aspect that the ICW paper I mentioned a bit earlier on has covered off in a bit of detail is the accounting treatment around the government-backed loans, so the sub-bills loans, the bounce-back loan schemes. If you're looking for a bit of inspiration about the account, how the account actually work there, I would very much recommend that you do have a look at the Institute paper. I think a more common question that we're getting though is quite simply around how would the accounting work in the event that maybe the bank has allowed the company to not pay loan payments over a short period, 1 month, 2 month, 3 month period. And what's now happening is they're looking to catch up. How would the numbers work to drive the actual debits and credits washing through the accounts? And here's the sort of situation really. So company has got an outstanding mortgage balance of 100,000 at the start of year 1, 5 annual payments of 24k left to be made, at which point the loan will be repaid in full. But the bank gives the company a 1-year repayment holiday on the mortgage, but annual payments in years 2 to 5 will then need to be increased to catch up. Now, I think when it comes to working out the numbers in these sort of situations, what you really need, I suppose, typically in Excel, is going to be a little bit of a loan repayment table to work out what your actual credit is going to be, what your creditor split is going to be, what your interest charge is going to be. The challenging bit, I suppose, in the context of Excel to put that table together is what would your effective interest rate be? And yeah, I think the goal seek function under the what if tab in the data ribbon in Excel is a very good way of determining what the effective interest rate would be to work the figures through in the way you need to in the situation like this one, where the mortgage repayment holiday has now ended and the repayments need to catch up. Now, how would that work in the example here? Well, let's see this on the next slide. So if you know that your opening balance on your mortgage is 100k at the start of year 1, you know by the end of year 5 you're going to be repaid in full. We've had no payments in year 1. The 24k per annum over 5 years now becomes 30k per annum over 4 years, 120,000 in total. And yes, what you then do is use the goal seek function to determine the effective interest rate, to drop in the interest figure to make the figures in the table work. So I think use of Excel is the key tool here. Off the back of that little repayment table, you've got all the information you need to drive out the creditor split, and the interest charge as well at the point that particular reconfiguration of the mortgage takes place, based on the help they're being given by the mortgage company in relation to waiving or to certainly deferring that first year's payment. Okay, let's finish with a few audit considerations. Just going back to what we were talking about a bit earlier on, I think the need to bring grants providing immediate financial support for companies in financial distress into the P&L per paragraph 24.5e is very unpopular based on the tax implications of so doing. That, therefore, I think from an accounting point of view and an audit point of view, is looking at very, very carefully. So do look very carefully as an auditor at the actual terms of the grant. And yes, if it does fall into the category of one of those paragraph 24.5e grants we mentioned at the early part of this short session, that would be a this year income item rather than a next year income item, which could be a bit tricky, a bit contentious in the event of the company concerned having a 31st of March 20 year end. The accounting, as I mentioned, for the CJRS grant, I think is fairly intuitive. I've certainly read a lot in the press of late. I've seen a lot on the HMRC website of late around the perception there's and certainly being CJRS grants claimed in error or indeed claimed fraudulently. And from a pure accounting point of view, I guess, where you're in a situation whereby you're of the view that we actually applied for a grant, booked it, but we're now obligated to repay it, there'd definitely be a need to make provision for that obligation to repay. And I certainly think from some firms' point of view, that could certainly be a material misstatement risk in an audit you're doing for a company where they've depended very much on that CJRS grant. Just to be clear, from your point of view, they were entitled, and there's therefore no obligation to make repayment provisions, which could be the case if they weren't. Rent waivers, I think the key sticking point there, going back to what we talked about a bit earlier on, would be, are there significant changes to other terms and conditions? And that could then mean, as we mentioned, that the more convoluted spreading approach becomes more pertinent, as opposed to keeping it simple and quite simply bringing that benefit in the P&L in the months in which the rent's not being paid. So do look out for that. I think from an audit point of view, looking very carefully at rental agreements is going to be quite key, just to get comfortable that they do meet the criteria, and there is therefore logic to accounting for that particular waiver in a more intuitive, more straightforward way. Yeah, and the point you made a few minutes ago around the mortgage repayment holidays ending was a fairly straightforward accounting point, I suppose. I guess from an audit point of view, the hot topic I think still currently is more around loan covenant compliance. And I guess remembering that whilst in a company's inability to comply with loan covenants may have implications from a going concern point of view, there's also the more immediate issue of where you breached a loan covenant pre-year end, but the banks waived that breach or forgiven that breach post-year end. The post-year end waiver of a pre-year end breach is a non-adjusting post-balance sheet event, and you would therefore need to think very carefully, I think, about the need to reclassify what otherwise would be a long-term liability as a short-term liability in the year-end balance sheet. Again, not popular, but a very important point I was supposed to emphasize at the current time. Okay, so that ends this short session. We've talked a bit about government aid, we talked about rent waivers, we talked about the repayment holidays, we talked about some of the key audit considerations, and I tried to focus on the practical issues we're getting asked lots on courses, and that hopefully gives you some good insights into the way that works at the current time. If you've got any comments on this short session, do drop us a note at inquiries@insight-training.biz, and do check out our website, www.insight-training.biz, for more details on our public program courses and to book on. Hope that was useful. Look forward to speaking to you all again soon. Goodbye.